the truth about Viavi Solutions Inc. Okay, these guys are really interesting, and the reason why is if you take a look at their chart now, you just kind of zoom out a little bit, you can see that they used to be, a $600 stock or so, and now they're a $9 stock. But if you zoom in, it's a little bit interesting because the stock kind of has like consistent growth, and so the question is this some kind of dot-com bubble company that went bust and now it's crap? Or is it a company that maybe was really overinflated when it started, but now it's starting off again on a new leaf and trying to do something new and innovative and really grow their shareholder value? Whether or not it's going to go back to 600 is a little bit beyond me. But the question is, does this company have valid overarching long-term growth? And also, is there something here that can be, nice for a medium-term swing trade? And that's kind of the takeaway here. If we scroll down in Yahoo Finance and we just kind of look at their description of what this company does, we're going to see that they're based out of San Francisco, or San Jose, and basically they provide test monitoring, communications, services, to enterprises and manufacturers and governments and the military, blah, 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 blah. And basically they are sort of in, if you go over to their website, you can see that they're sort of in like networking. So they do stuff with like 5G, which is some new up-and-coming tech, which is super, super important and cool. And they also do a lot of cool stuff, it looks like, with like aviation and I guess communications in that space. Here they talk a little bit more about sort of what it is that they do, which is kind of interesting and complicated-ish. They got a lot of freaking cool clients. Like they work for Boeing, Samsung, T-Mobile. I mean, like they look like a pretty solid company at first glance. And they just kind of, I guess, do something that's kind of complicated and hard to explain. If we go back over, apparently they work for like literally everybody that exists, which is pretty interesting. So, I mean, basically the point is, you can, I guess, it's a pretty complicated description of what they do. I mean, it talks about like technology training and consulting, and this is probably the longest description I've ever seen on any page on Yahoo Finance ever. So basically, it's kind of a complicated company that also, I guess, does optical products. It's like they're a little bit complex, but at the end of the day, they're worth about $2.2 billion. So this isn't like some company that was worth like $1 bajillion. Now they're worth like $80 in their penny stock. Like this is a company that's worth billions of dollars. If you look at their float, most cheaper stocks have lower float. These guys have a float about 228 million, which is really, really good. It shows they got like at least some float out there. But really the more important thing I think to look at here is if you look at their revenue growth, they're doing about $1 billion a year in top line, and they're kind of struggling to turn it into profit. Some years they lose 100 million, some years they make 100 million, some years they make 160 million, some years they lose 50, some years they make 4 or 5 million. And so the books here and the financials are really going to be something that we need to look at a little bit closely, because the question is, after a company that's been around for, since 1993, it's like, what, almost 30 years now. They've been around for 3 decades, so like they should be a consistent profitability. And if they're not, like what's going on with them? And just to give you a little bit of a better perspective, because this is a really, 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 really kind of like exploded chart that makes it really hard to actually read the underlying stock price. If we look at just like the years after the dot-com bubble, we can see probably a better understanding of how the stock has changed value over time over the past couple of decades. So here we can see they kind of went down, before the 2008 crash. It's hard to see the stock just because of the way the moving averages work after the really, really big dot-com crash. But basically we're looking at, they did a bunch of like forward splits in the dot-com era. So they were doing like 2-to-1 for forward splits, 2-to-1 forward splits, 2-to-1 forward splits, 2-to-1 forward splits, because their stock was, exploding from like $3 to 300 or 600, which is crazy. But then they kind of got into sort of where they are right now. They did an 8-to-1 reverse split in 2006 to stay above $5, and then they kind of had the crash of '08, and now they've been coming back up recently. They actually did a forward split. It was about a 1.7-to-1 forward split, and like they've been doing like pretty well up until this crash. There hasn't been much like to say. Like this looks like a pretty decent company. After '08, they went from they originally started at like $10 and they went to about $1.60, And then within the span of, I would say about 1, 2, 3, 4, 5, 6, 7, 8, probably about a year. They went from about $1.20 to $9 to $7, $8, $7.50. So like these guys have historically moved a lot after a crash, and I guess in the .com era they've historically been extraordinarily volatile. And I'm not like, we can't really do anything about it, but that's a pretty nice M setup right there that we could have traded if we were alive 20 years ago, or traded this 20 years ago. Like a nice M right there, and then you just shorted it like 400, you cover it like 200, and puts on those like guarantees like freaking 30,000%. But what's cool is now they're trying to crash again, because you have sort of the overarching market crashing. And what I really think could be a play here is if they do kind of what they did in 2008 all over again, where they go from being like $1 to $7, and then you can leverage that, and you're looking at a lot of money on that table right there. If they kind of mimic what they've done historically in the past during market crashes. So that's kind of what got me interested in the stock in the first place, and made me look past the fact that I have literally no clue what they do. If you go to their websites, you can go to their solutions, and there's like enterprise and data, and like networks and governments, and there's a tab for technologies, which I guess these guys made PCIe, which is cool. They do a lot of stuff. I'm sure they're a very complicated and very useful company. But when your website has a tab for how to buy, that's usually like when you know that you're paying like 6 to 7 figures to 9 figures plus for these guys to come and do things for you, because you can't even like order things. There's a button for how to order. Usually like, if you go to Apple's website, you see a giant button on every product page that says buy or add to cart or whatever. And when you have a button that says how to buy, and then it says basically call us, I don't know, it's just, I don't know what the hell they sell. But I'm sure like if you're in this industry and you're in this business and avionics testing is like all the raging for you, then I guess what they do is worth a lot of money, because they're a $2 billion company. If we take a look at their financials, we're going to see that they have like a pretty nice growing revenue. They got from about 900 million to about $1 billion this past 12 months, which has been really nice for them. Their cost of revenue has been growing, just I guess as they grow with more revenue. They haven't had that much R&D. It's like 200 million. So I would say maybe like 20% of their net income or their total revenue is getting put into R&D, which is great because it's a high-tech company, so it makes sense for them to be investing a lot into some high-tech stuff. If you look at all the other expenses, they're pretty basic. This is kind of what you would expect with a stock of any kind of company. Their balance sheet is similar. If you look at their book value right now is at about $332. And so for a $9 stock, that's not great, but it's pretty damn good. If we're looking at profit targets here, usually what you're going to see is a price that's about 2 times the book value. So that would give us a target in the short term of about 660 as a price target, and that's kind of like right here. If this drop would get down that would be a nice little price target. Anyway, going over to the balance sheet, we see that basically they have lots and lots of cash. They have about 500 million in cash, and I don't know why they don't invest it, but whatever, right? A lot of inventory, but for a $2 billion company, 100 million in inventory isn't particularly much, so not a big deal there. They have about 500,000 in like plants and stuff like that, which is about a quarter of their company's net worth, which I think is great. It shows that they are manufacturing something. You got a lot of goodwill here. I'm sure it's well justified, because if it wasn't, they would get audited like hell. And some intangible assets, which I guess is like what makes all the big brands want to work with them. I don't know. If you have to submit a W-9 to buy their stuff, then that they're taking in some big money from their clients. So I'm guessing they have a high average client value. Besides that, not much else to see here. They have some liabilities just because of, I guess, accrued liabilities, and we'll look at what that means inside the report soon, but not too much to worry about. Long-term debt's at about 600 million, and I'm guessing that's to pay for the 500 or so million of plants and stuff. That's probably like real estate debt. Besides that, there's not much else to see here. They have, amazingly, negative $69 billion in retained earnings, which I'm assuming is carried over from when they were like a gigantic like explosion stock. My guess is that on paper they lost like billions and billions and hundreds of billions of dollars when this went from 600 to 10. And I think that's why their retained earnings is so absolute garbage. This number really is only going to be possible if you have some kind of insanely massive loss that, like on the books, it comes from your stock, I guess, plummeting from 700 to 10. So I'm guessing that that's why they have such a massive amount of retained negative earnings. And that's probably most of the money that came from the original IPO back in '93, and a lot of the money that came from original funding. So what this shows me is that there is very, very, very likely a pretty big chunk of the investors in this stock, or at least a solid amount of them, they kind of got in when the stock was sort of exploding super high, and they sort of like bought here, they invested here, and like there's no doubt in my mind that this company, which I don't really know what they do, this is kind of a complicated company, but like they were probably raising the hell out of money when they could, when their stock was super high. So my guess is that they brought in like hundreds of billions of dollars, like a ton of money, when they were when they were valued at 700 a share or 600 a share, and then now that they've kind of crashed a bunch, first of all, there's a couple things that have happened. So the first thing is, like these guys right here are going to be pissed because this is not like half of 7. This is like, I don't know, 15 maybe. So we'll call this like 15. Like this is really bad. This is like 700 to 15. This is like a minus 99% loss. Like that's really bad. And so there's a couple of things here. The first thing is most of the original investors, if they were good investors, probably set a stop loss and are out of this trade, which means that you're not going to have a lot of people that are just back holding it for it to go to like 700 again. Really, a majority of the people that are likely holding this stock right now are individuals that kind of got it around this point forward, where they bought it when it was like $1, or they bought it when it was like $5 or something like that. So you're not going to have a lot of people that expect this to be a $700 stock, because in all reality, your stock doesn't go from 10 to 700 unless A, you're in a freaking gigantic bubble and you're one of the biggest, I'm sure there's like tons of people that, like, this stock must have been well known because it went from $3 to 700, but that just doesn't happen unless you have some crazy economy that lets that happen, and that's not really something that looks like it'll happen anywhere in the near future, anytime in the near future. So the first thing here is to understand that they're going to have a lot of money from here that basically got blown on the way down on some crap, and so they lost a lot here. And the thing is, when they started out, they got a lot of this money basically just like thrown at them because of how many people wanted to invest in the tech space. And I think what that might have done is given them a lot of bad habits of like spending tons and tons of money on stuff that doesn't matter, or maybe on spending it without getting a return on it. And that's why I think that today, let me draw this in, I guess, over here. Today we have, I think, negative 64, 69. You got negative $69 billion in retained earnings, and I'm like pretty damn sure that that's coming from like this time frame right here when they were dropping, and they dropped way faster than this makes it look, but I'll just draw it like this. I'm pretty sure they probably lost like $100 billion, or we'll call it $70 billion or something, when this was going on right here, and that has led and held up until the current present moment, in terms of their retained earnings. Now, if that makes sense, Is that okay? Is that cool? Okay, you understand that? So they lost a bunch of money here, and they get to keep that loss on their books until perpetuity, basically. And so here's the cool thing about that. First of all, it kind of sucks to lose $70 billion. Second of all, there's a cool little secret of why Amazon is making billions or trillions of dollars and not paying any taxes on it. And it's really easy, because they followed a chart very similar to this. Basically, throughout all of their sort of careers at company, they have constantly been reinvesting
into R&D. And R&D carries forward just like retained earnings carries forward year to year. And they can carry over those costs substantially well. And so when they lost all this money, when Viavi lost all this money, they're able to carry that forward forever and ever and ever and use it to sort of go against their earnings, to go against the money that they make. And so they can make,
they're making $1 billion right now, it looks like. Yeah, $1 billion. They can make $1 billion right now, like this year, and they make $1 billion. And let's say after all the deductions and all the expenses, et cetera, they subtract all of their expenses. Let's say at the end of the year they have a net profit of like $250 million, okay? That $250 million would normally get like taxed and stuff, but here's the cool thing. Because they have this gigantic monstrosity of retained earnings losses, they can just take this number right here and then subtract it from 69 billion, and now their retained earnings becomes 68.75 million, right? So the retained earnings becomes it doesn't fucking budge because they're not making anywhere near 69 billion a year right now. And so what's cool is that because of this little trick right here, I wouldn't call it a trick. I mean, it's not an intentional thing to lose $69 billion. But because of this right here, they're essentially going to be paying no taxes for the rest of their life until they make $70 billion. Because the government looks at this and they say, okay, you guys lost all this money. We're going to let you use this against your future taxes forever and ever and ever and ever. And so until they make $70 billion in revenue, in taxable revenue, in taxable earnings, they're basically never going to pay taxes. And so that's sort of a cool little trick that they kind of have sort of accidentally stumbled upon. Amazon does the same thing. They were very, very similar. They had this big spike in the dot-com bubble, and they've kind of been growing, if we call this Amazon right here. They've been growing a little bit better than these guys have by a factor of 1,000. But anyway, what they did is really cool. They basically expense a lot of research and development costs every single year. So they would spend, just throwing out numbers here, $1 billion on R&D this year, $1 billion on R&D this year, $1 billion on R&D this year, $1 billion on R&D research this year. And what's cool is, when they were starting out, they didn't make money for the first 20 years or something. So when they had a net loss of $250 million this year, $250 million this year, $250 million this year, until eventually they reach profitability. What's interesting is, let's just draw this line here, okay? This line is Amazon reaching profitability. What's cool is now that they're making what's their revenue? So now that they're making, I guess, 280 billion a year in top line revenue, and we'll call it, 12 billion a year in earnings. This 12 billion, is not actually getting taxed. And the reason why is because over the years, they had all these accrued expenses for research and development and all these negative retained earnings. And these all add together. So you have 1 billion, 2 billion, 3 billion, and then you add up all the research and development costs over the years. So they add up their retained earnings and they add up their research and development. And now you have, cumulatively, I think the number was somewhere around the bouts of $32 billion. And so once Amazon finally started reaching profitability, I don't think they paid taxes for 3 years because they had so many negative retained earnings and negative carryover research and development costs that they could make literally tens of billions of dollars and pay zilch on it, because they would basically just take, let's say they make $12 billion, they take the 12 billion and then they add it to the negative 36 billion or 32 billion, and now they have negative 20 billion, right? So they get to carry this over to next year, and it just goes on and on and on until eventually they recover all of their losses. And only then, once they have an established business and they are proven to be profitable, established and proven to be profitable, only then do they actually have to start paying taxes. And that is the beauty of the tax system. It works really, really, really well for incentivizing investing in the creation of new companies. And with this specific example with Viavi, what we have here is basically a company that's never going to pay taxes unless they accrues $69 billion in taxable earned income, which is, from the looks of it, them being a $2 billion company right now, something that could be, a little bit ways away. And so that's going to be a really, really solid incentive and a really great long-term growth factor. When you look at this stock, the fact that all the money they make basically gets to stay in their pockets, and they aren't going to pay much in taxes on it because they have such a phenomenally huge amount of negative retained earnings. Besides that, not much else to see here on the balance sheet. They have positive stockholders' equity, which is great, especially for a company like this. It's good. It's really nice to see a positive stockholders' equity. All in all, they look like they have a pretty nicely done accounting and management schema with whatever it is that they do. It just looks like a solid company. If you look at the way money flows in the company, you got about $40 million in net income. This company, they used to lose money, then they made $166 million. So it kind of looks like they go out and they get a client, and then they make a bunch of money, and then they don't eat until they get the next client. I don't think they have a lot of recurring revenue. It looks like it's more of a project-on-project basis company, which isn't phenomenal for long-term growth, because what happens when you have a company that doesn't have sort of a proven way to create revenue consistently is you have really big spikes in the stock price where, for example, not like that big of a spike, but for example, in 2011, when the stock went from 7 to 15 in 3 months, 2 months, 1 month even, that probably happened because they landed a really big deal with a really big client and then temporarily made a bunch of money, but they didn't actually do a good job of sustaining that money over the long term. And so that's going to be one thing that really harm the value as an overarching longer term investment, is they don't seem to, from what I can tell so far, I'm going to look at the report soon, but just based off of these books and based off of the cash flow of their company, they don't seem to have recurring revenue, and that's really going to hurt them in the long term. So that's kind of the first thing to see here. Besides that, you have some pretty normal expenses here: depreciation, amortization, everything here is pretty basic. $40 million in stock-based compensation for a $2 billion company, not a big deal. I really was expecting to see a little bit more net income here, but I guess it just kind of factors into the revenue. Apparently they have done negative inventory, which is interesting. Besides that, they got about $100 million in working capital, which is great. Nothing else too, big here that stands out. They did a couple acquisitions. One of them was for about $500 million, which is pretty impressive. I wonder what that was. Okay, so apparently they were reinvesting in their business, and they acquired this company called Cobham Avcom, and for wireless testing and measurement. So again, going into their business, that is a really, really nice strategic acquisition that they made to, I guess, expand their business, which is super freaking cool. Really, really cool to see that, because that is a nice way for them, I guess, to get into that new business of being in wireless testing, which is, I guess, part of their core company. Besides that, nothing else super huge here. They do a couple $100 million in debt repayment. For some reason, they haven't paid that much lately, so they're probably gonna have to pay up a bunch for their debt soon. That's probably gonna hurt their 2019, or I guess their current profits. They do a little bit of stock repurchasing, which I don't really understand. That doesn't really make that much sense. But I guess they want to invest in themselves and they want to buy back shares in the company. Besides that, not much else to see here. They got about $600 million in the bank and a good chunk of cash just to operate with, which is really, really cool. So looking at the books, what we have here is a company that is well managed, well run. Everything here looks solid. The numbers aren't phenomenal. They're not stunning. But the management of those numbers looks pretty rock solid. They're doing a solid job managing the company and the resources that it does have. So that's really great to see. It's super cool. So with that said, let's go over to the report now, because basically there's 3 things I want to know. The first thing I want to know is this going to be a good long-term play? I don't think this is going to go to a bajillion dollars, but maybe it could go to, I don't know, 50. And the second thing I want to know is, how far down you think they could go during this recession. $6 is possible, but hell, maybe they could go to 2. I don't know. And then the last thing I want to know is this a viable company? Are they going to go bankrupt? Are they not going to go bankrupt? Because frankly, they've had a pretty rough journey, and they've gotten to some pretty low points, and they had to do a reverse split in 2016 just to stay listed on a lot of exchanges and to be open to institutional traders. So that's what I think we're going to learn when we go through this report right here. So with that said, it's pretty nicely formatted, at least at the beginning of it. They had a cool little logo. They inserted a video or an image of a signature, which I know it sounds crazy, but there's a good chunk of companies that just make their entire report like in Microsoft Word or in LaTeX, and they never even freaking like insert any pictures ever. And it's like reading the dictionary. It's so boring. And so it's good to see that they're at least freaking trying for their investors to make it a little bit interesting. The first part here is about their annual meeting, which we don't have to worry about because we're not, I mean, this was like a year ago or something, so it doesn't matter. They're going to do some stuff like that. So just like, compensation is basically the only thing that really matters at annual meetings is can we get paid more, please, and thank you. And usually people pay them more so that they make more money for the company. After we get past most of that stuff and a lot of the proposals they have, we get to the K1 eventually, which is great. A couple of stuff here about the restricted stock that they use. They pay employees in stock just like most startups do. And that's the cool thing about these companies. Even though they're really well established and like super long time been around, it looks like just from a glance that they kind of operate like a startup. So they're constantly being innovative and constantly trying new things. And also they're mimicking the startup technologies and the startup strategy of losing lots of money, which means that they can have really volatile stock swings and then all of a sudden make a bunch of money and have, and this is obviously influenced by a market recession, but I mean, just think about like if they could do that again right now, like you're looking at a pretty nice volatile stock. You make some nice like 4 to 5 to 6 month trades on, and that's pretty dope. I can get behind that pretty hardcore. After that, they talk a little bit more about the directors and the people, which is super cool. And then they get into the cool stuff here. So this is compensation. No one really cares. They all get paid a bunch of money. That's super cool. Okay, awesome. There we go. So here's our report. So as we get into it, what I really want to look for is like what they do and what sectors they're in, so I can kind of tell like what market factors could influence them. First thing I see here is wireless and 5G, and those are two things that I love to see together because 5G makes every investor I know have like super hyped up. And so I think it's really nice to see that they are basically in this sector. I remember I think AT&T added like 5G just as like a name to one of their smartphones, and their stock went up like 30%. So 5G is good. If they have like actual legitimate 5G technology, they didn't even have 5G technology and they did that shit. So if these guys are actually working on 5G, that could be a really big play. They also apparently make like the stuff for LiDAR for like self-driving cars, which is also a really like a market that investors will pour money into without really thinking about it, which is great because that means the stock can explode, which is super cool. Here they talk about their competition. Some of what they do is called anti-counterfeiting for like crypto security or cybersecurity. I don't really know what that is, but apparently there's like 4 other companies that do it, and I guess that's good because it shows there's a market for whatever it is they sell for anti-counterfeiting. Not 100% sure. I guess it says right here that governments use this for currency protection. Oh, okay. Oh, no shit. Okay. So I guess these guys sell the stuff that you put in on a dollar bill to make it so no one can counterfeit it. So that's cool. That's got to be a hyper-competitive market because you're selling to governments that have infinite budgets. So I doubt their margins are much on that sector. If we look at the overall corporate margins, we're going to basically see that they take in about $100. For every $100 they take in, they get about $5. Their operating margin is 8%, their profit margin is 4%. So it's a pretty damn tight business. I think they have a lot of competitors because there's just a lot of people in the IT space that sell a lot of things in the IT space. And so competition is definitely going to be big with these guys. Like if a news comes out about a competitor that's really good, then these guys get tank pretty hard because of it, which creates a nice temporary short-term opportunity in the stock, which is pretty cool. Then talk about their acquisitions, which we kind of covered. They bought a bunch of stuff to expand into different markets, which is great. Some of it's in the car market, which is also cool. Besides that, not much else here at the beginning. And then they kind of give these risk statements about, they need to basically carry their net operating loss forwards to offset taxable income, which may have certain limitations because apparently there's a limit of $5 billion to $722 million for carryover credits on a year-to-year basis for state taxes. So if you have more than $5 billion in losses, apparently you might have to deduct a little bit less than all of it for the state taxes. Which is just an awful thing. No, it's not bad. That's fine. It's not a big deal. It doesn't make that big of a difference. We talked about this earlier. Besides that, cumulative return is pretty bad. Kind of matching the market, which is pretty bad for the risk factor that you have here. So they haven't been doing too great lately. I think the really big game is in shorter term swing trades, not longer term investments with this company, just based off of everything we've seen so far. We already looked at the numbers. They make money basically. A lot of their money comes from this sector called NE, which if I do a quick spotlight search, we can maybe uncover what the hell that means. So I guess NE could maybe be like network equipment, and I guess SE could be like service equipment. I really don't understand what these guys do, like, at all. It's a pretty complicated techie business, and so for me, like, I would invest in these guys in the long term because, like, I just don't know what they do. So if you don't know what a company does, it's really hard to have faith in them in the long term. It would be kind of cool if they explained it, but they don't, from what I can tell. Most of their revenue comes from America, but a solid 84 million comes from, I guess, not America. So you have a little bit of international risk here, which isn't like great, but it's also not awful. It's not that big of a deal, especially considering what they do is based in tech and cybersecurity. There's no surprise at all that a lot of their money is going to come from overseas accounts, and basically they just have to take it in and be fine with it. So that should be okay. Their R&D is basically accounting for their acquisitions, it looks like, which is a little bit of a sketchy accounting trick, but I guess it works. And I guess they also decreased their restructuring activities. So they're classifying restructuring activities under R&D, which is a little bit sketchy, but the important thing to note from that is they aren't necessarily doing as much internal research. They're mostly just buying people that know what the hell's going on, and then leveraging the companies that they buy out because they have so much free cash just sitting on the side. So what this is going to do in the long term is it's really going to stutter the growth because they're relying on other people to do the work for them, and they're not actually like hiring people to do things or like research things. And instead they're just buying other companies at a premium to kind of leverage what they've already done. So what's cool is, like, that's bad for the long term, but in the short term, that creates a boatload of volatility. So that's really, I think, going to be a nice little way for it to have some of these really big growth spurts, some of these really big dips is if they make a good acquisition or a bad acquisition, that can lead to a lot of inherent volatility and volume in the stock based off of the name that they bring in, if it's well known in their company and their sector. So I think that's a cool little chunk here that kind of gets overlooked a little bit, but it's one that could really help these guys in terms of being a little bit more volatile than ever before. Besides that, they talk about sort of how they buy things and how they expense things. Not that big of a deal. They talk here about something called Lumentum separation. So these guys apparently were sort of a child of Lumentum. If you guys didn't see the video on Lumentum, definitely go watch the video on Lumentum. Pretty dope stock there. I guess Lumentum was one of their clients, and now they're not one of their clients. And there was about a $2.4 million client that they lost, which kind of sucks. So I guess that's cool. Not much else to say about that. Liquidity, capital resources, a lot of cash obligations, contractual obligations. Not that big a deal. These are basically just, I guess, debt and also accounts payable. Their debt here looks super cheap. Like, they have 1% debt, which is awesome. It's great. I mean, that's like awesome to the max. They have so cheap debt. So even though the return on equity and the return on assets and their general margins are crap, they do have super cheap money in their business, which is why they're probably able to fund a lot of these acquisitions because they have such cheap debt. And so that should kind of help them in the long term. Besides that, there's not much else here. They don't have any off-balance sheet stuff, which is great. It means they're not doing some Enron crap. And here we see the return on assets is about 3 to 5%. So they turn that debt as 1% into about a 5% return, which is awesome. A little bit of credit risk just because of their international exposure, which is fine. And then obviously they have to service their debt. And that's kind of what I get mostly from here. This isn't one of those pretty reports that explains to you what the company does, like, which kind of sucks because I still don't know what the company does. But you know what? I mean, that's their loss, right? Like, they're losing long-term investors because no one, at least no one, like, I don't know, like, I don't get what this does. And like, I would like to think that I know a good chunk about technology. And so I'm sure there's a lot of investors that just kind of glance over the stock because it seems kind of complicated on the surface. And their business model seems kind of complicated on the surface, selling to treasury, selling to the government, and selling to big corporations. It's a little bit like, you know, hard. Like, it's not like a household name brand. And so I think that's cool because what it does is it sort of alienates a lot of investors, and therefore it creates lower amounts of volume, which creates higher volatility, which makes it a really good stock to make shorter term plays on, because not a lot of people are focusing on it. Like, there's probably maybe, like, I would say, I don't know, a couple million people that know about this stock. And in the world of finance, that is super, super dope, because it means that only people that like are going to follow technical setups and are good at investing and know what the technical setups are going to follow those setups, right? And so the stock is much more likely to actually create really, really, really nice setups, and therefore build those setups and then turn those setups into money. Because most investors that know the setups actually want to follow the setups and therefore instantiate the setups. And you know, one thing leads to another, and you have a lot of really nice growth potential when you have a group of investors trading a stock that know exactly where they want the stock to go to, and therefore will incentivize that to happen by not buying or selling in between where they get in and where they're targeted. So, for example, there was a W set up on these guys in 08. So with a W set up, basically you've got your W, and then you kind of just take this and you add it twice, and you do like times two of these, and that's kind of where your profit target is. So what's cool is when you have a group of investors where like most of the investors know what the hell they're doing, and they're all trading the stock, like you'll have a bunch of people that buy here and very, very quickly like stirk up really fast because everyone knows that this is the breakout point on the interior Bollinger Band W setup. And then, you know, it'll kind of chill out for a little bit, but people won't dump it because they wanted to get to this 2x target that they have for themselves. And so then it'll eventually kind of get up to that target. And that's exactly what these guys have done in the past. And the reason why is because so people know about them. There's less retail investors who don't know what they're doing. And therefore, there's more people that know what they're doing and are going through stuff like this and actually trying to invest in their education. And so they understand setups like this. And then they trade them, and they don't sell until they get to that profit target. And then once you get to that profit target, the thing freaking dumps because everybody knows that that's the price that they wanted it to get to. So that's sort of the big takeaway here is with less general people here, less people is going to lead to more volatility, which is awesome. And more importantly, I think probably the bigger thing here is more volatility is better setup completion. And when I say better, what I basically mean is freaking awesome setup completion. And that's the big takeaway here, is when you have technical setup on a stock like this with low volume and low initial interest in the public, and it's difficult to understand underlying company, these technical setups are going to validate really, really well. And then after they validate, they're going to fulfill really, 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 really well. And that's what I love about this company that I literally found on an accident looking through Google. And it's cool, like I literally find like maybe 10 or 20 stocks a month on accident, and like one of those stocks will turn out to be like an investment that I'll make, and it's like freaking so interesting to think that I found him on accident. And anyway, like anytime I ever see a ticker, I constantly look up the stock immediately. And the reason why is because you find one of these stocks where not a lot of people know about it, and you found out about it on accident, all of a sudden you can have a cash cow just sitting in your portfolio waiting for you to trade it. And I think that's kind of what we have here. This is by no means a long-term investment. I have no freaking clue what the heck they do. What I do know is that they do enough cool stuff that they aren't going to go bankrupt tomorrow. They're not going to go bankrupt next year. And frankly, if they can make it through the dot-com bubble and go from $700 to $400 to $4, then these guys can power through anything. Like there's a very, very, very minuscule chance that they go bankrupt because they have just proven over and over again that they have so much history in the market. And obviously, you know, if they run out of money, they'll go bankrupt. But I'm not really too worried about it if I'm making like a 5-month trade on them. Just set a stop loss and you should be fine. And with that said, I think that's going to kind of empower them to be. And what's cool is they're also like, there's some companies like Top Ships where like the CEO gives up on the stock, and in a matter of, I don't know, we'll call it a couple of years, and I don't even know if this will show up on TV, but I'll give it a shot. The stock goes from about what is that, $270 million? No, 27. Yeah, 20. Stock goes from $27 million to 9 cents. Those are the kinds of stocks where like people give up on the company after it starts to fall and fail, and they give up on the company when it gets to a measly $47 million per share. And the reason why these numbers are so huge is because they've done like 17 reverse splits. It's freaking insane. But anyway, they go from $26 million, $27 million share to 9 cents a share. Like eventually, throughout this process, somebody gave up on this company, and after they gave up, it was done. It's over. Okay. But what's cool about Viavi is the company had a humongous drop, but nobody gave up on it, and they still have like some of this overarching growth here, which is not true. If I zoom in on Top Ships, you're going to see a very different story where basically it only goes down forever and ever and ever and ever. Whereas with Viavi, you have a company where like the executives and the people that run it, and the people that work for it, actually give a damn, and that's really, I think, going to be the saving grace here that's going to empower it to be a really nice swing trade. Is that there are people here that actually care about the company, and as long as there are people who still care about the company, there's going to be potential for trades here, especially when you have volatile markets, and that's what I love about this stock right here. As for the financial reports, there's not much else to see here. They're going to talk about their debt. They're going to talk about, I guess. Oh no way! They talk about what they do. Oh, sweet. Okay, so the first thing to do is network enablement. So network enablement allows you to build out and maintain tasks. And this is software that they build, and they troubleshoot software, they optimize networks. Whatever optimizing networks means. I'm thinking that's a thing for big companies. They also offer professional services such as repair calibration and software support. What? That's cool. The avionics products produce test and measure solutions for aviation. These guys freaking build flight simulators. That's cool. The government, defense, communications, public safety, people that are trying to learn how to fly freaking fighter jets. These guys got this covered. Viavi has the solution for them. Then they have the second sector called service enablement. And service enablement yields networks, services, and application performance data. These solutions include instruments, micro probes, and software that monitor, collect, and analyze network data to reveal client experience and identify opportunities for new revenue streams. Dude, that's freaking high tech if I ever heard of it. Last one is called optical security and performance products, which provide high-performance optical products for anti-counterfeiting currency, like we talked about earlier. They make anti-counterfeiting stuff. Dude, that's freaking cool, I guess. A bulk of their money comes from network enablement, which means, I guess, consulting on a one-on-one basis with big Fortune 500 companies or some of the likes for their internet, I guess. So, dude, they land a big deal for $100 million, their stock will explode. And that's something that I really like about the company, is they have that surprise factor of, if they land a deal, they're gonna freaking pow it out. If they don't land a deal, they're gonna go down like no one's business. And that is something that makes them a very incentivized swing trade position, because they have so much of that volatility. As long as you set a tight stop loss and you follow just any technical setup ever, you're gonna be looking at some nice trades on these guys, assuming they form like any kind of valid setup. Okay, sweet. So everything else is just the numbers that we've already seen, and then talking about their international business. Most of the money comes from the U.S., but some of it's also from internationally, which is great to see, especially for their self-driving car stuff, and I guess also their whatever they call OST. I mean, I don't know what that is, but for their currency, yeah. So in Europe, I guess they have a lot more anti-counterfeit stuff on their currency. So a lot more of their money comes from Europe for that sector of their business, which is super cool. I don't know if you guys have seen Europe, but it's like magic. They got like purple stripes, and they're freaking like way more secure than US dollars. but it's pretty cool. So I think that's the deal with Viavi. This is not a company that I would like to hold for the next 30 years. However, this is a company I'd love to trade the heck out of right now. And I think that's kind of the sweet spot they fit into right here. So if we go over to the weekly chart and we look at what they're doing right now, basically we've got a company that, and I'll kind of zoom out a little bit more. We've got a company that is kind of reacting pretty hardcore to the overall market right now, which is very, very, very reasonable. These guys are tanking. They're below the 200 weekly moving average. They're also, if we go over to the monthly over here, and we'll probably have to zoom in a bunch just because of the history of this price. They're sort of approaching their 200 monthly moving average. They hit it temporarily at like $8. But in all honesty, last time they got this low, they crashed below these moving averages by like a factor of 50%. So I really think we are not, like, there's a lot of downside for this stock still, without a doubt. Like, this could be probably like, aggressively a $0 stock. Apparently this chart says that they were negative, which is probably not right. So I'm a little bit suspect of TD here, telling me they had a negative stock price. But when you have this much volatility, sometimes that happens where it says it's a negative stock price, even though it probably wasn't negative, because that's not possible. So I'm gonna just not use that chart from TD because it says there's a negative stock price. Which again shows the volatility of this company. Like, if you have a company that freaking can do that, you've got a pretty volatile play on your hands. I think these guys could probably conservatively go to like $5. And really, the setup here is not just like blindly buying the stock. What you really want to see here is some kind of setup. So here there was a W, and then they performed really well after the W, and that's kind of what we want to see happening right now. Is some kind of setup that happens on the stock, whether it's like immediate or not. I want to see them drop until probably about June, and then I want to see some kind of setup, whether it's a W, whether it's a wedge, whether it's a MACD crossover or stochastics crossover. I really, really want to see a setup here that's kind of like a momentum-based reversal setup, and I think if we can see something like that, this is a stock that could go from 7 to 15 pretty easily, just based off of any technical setup ever. I'm not going to make a trade on it right now because it's in free fall and it'll keep on falling as long as the market keeps on falling. But as soon as there is a setup, I really do want to look at the options on these guys, and I'm thinking like probably a 4-month play is pretty reasonable. So if we look at like 4-month options or so, the calls on these guys, like at give or take $1 or $2 out of the money, are basically $1. So you're looking, from 5 to 9. It's about a 4x return on your investment. You can buy calls that are like at the money for about $1.30. So I would honestly just go with that, and those are going to give you a net return on a $5 or $7 move of about a 7x return. And that's where the play here is. You want to see a good setup. As soon as you see a good setup, just trade that leverage with options. You're going to be looking at about a 7x return. If you trade it just based on equity, you're going to be looking at about a 100x return or 100% return, or double your money. So you can do 2x with equity, and probably I would set about a 10% stop loss with that. Or you could do a 7x or 700% with options, and I would probably set about a 40% stop loss on that. And that should do like really well once you have a technical setup. So this is a stock that I came across on accident. I didn't really understand until today, and it's one that I really am going to keep in my option swing trading portfolio and very closely watch. I'll put it in this 6-month option swing trade portfolio. The reason why is because this is a freaking dope stock that just kind of needs a setup to trade, and as soon as it has a setup, it is proven historically that it is very, very volatile. Like this move right here, from 6 to 15, that was a $7 move. That is a 7x return, and I think the market has only gotten more volatile since then. And so, I mean, I could easily see these guys doing about a 12x return on a $10 price movement from like 7 to 17, and that's pretty aggressive. But if you have a nice setup on these guys, there is no doubt in my mind that this could be a really nice trade. And even if you just go straight in with equity, which would be a little bit safer, you're still looking at like a solid 30, 40, 50, 60, 70, 80% gain here over, I would say, about half of a year, give or take. And I would definitely set a tight stop loss on that and make sure that you do have a solid technical setup. But the moment you have a solid technical setup, this is a nice stock to be swing trading. So that's really the big takeaway with these guys. And just a freaking really nice company here. So I'm really happy to see these guys kind of pull out from there's so many companies that just like went bankrupt in 2000 after the bubble. And it's great to see or a couple that really kind of have powered through and now have potential for future gains for new investors. Despite the fact that their stock is $10 versus where it used to be, like it doesn't really matter. Like I'll trade whatever it is if I see a good setup, and that's the strat here. Is this is a stock that is proven to create some really nice setups. I mean, if you look at the MACD crosses on this on the monthly, they are so bizarrely cool. I mean, look at this cross right here. It crosses right here. And, it goes from, I guess, what is that, 6? It goes from 6 to 10. I mean, that is a 4x return. That is phenomenal on the options. And see this crossover, I mean, this short is probably like a 7x return. And, assuming it goes to 5 and you have another cross, I mean, this is a solid stock to trade. I would just use basic technical analysis and especially candlestick patterns inside of Bollinger Bands, and you're going to be looking at some nice profits on Viavi. And that's the big takeaway on Viavi for Viavi Solutions. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learned a lot about them. Now, what's cool is if you have an investment that you think could look really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is you can comment down below with the ticker of the stock. I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out, or when these new stocks do come out, you'll be able to get, YouTube will know to send you the stuff. And if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very high-level seminar I gave. The students literally go through and in their first month make 5, 6 years. And I can't guarantee anything, but I know for a fact that this stuff works and it's gold. What I want to do is I want to give you this course I used to sell tons. I want to give it to you completely for free so you can learn the top 35 secrets that you can use within the next week to really crush your portfolio, really double it and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the masterclass. Thanks. Bye.